Good day, and welcome to yet another one of our Rand Swiss weekly wraps. As usual, we'll discuss what happened in the last week or so and how it'll affect you and your investments going forward. Three topics as per usual. The first is going to be the Rand, weakened dramatically, why, and what to expect going forward. The next thing is going to be a little bit of news out of the European Union around internal combustion engines. And finally, a deep dive into inflation. We had some interesting numbers coming out this week from the US especially, that might give us a clearer idea as to what to expect going forward. Okay, let's start off with the currency. The Rand weakened beyond 18 Rand to the dollar this week. I mean, just a few days ago, last week or so, we saw the Rand closer to 17. So that's quite a big difference in a reasonably short period of time, more than 5% in about a week. What drove this? A couple of factors. One of the things, of course, is of the situation with regards to some inflation numbers, some jobs numbers from the US and so on, that are obviously to be concerned about. Then we had, of course, the ongoing issue with regards to load shedding in South Africa, and institutions such as Fitch coming out and discussing the fact that this is a serious situation in terms of our credibility, our ability to pay back our loans, etc. If it continues for much longer. The Rand at about 18.20 or so, as I speak to you right now, is a significantly weaker currency than it was, like I said, a few days ago. And I think the justification behind some of these things is quite reasonable, quite frankly. Yes, we do have a situation in which it's probably above the trend line in terms of what we'd expect for the Rand at the moment, but they are untrendworthy or beyond trend factors also in play right now. Load shedding being one of the key ones, our inability to export as much as we normally should be exporting because of the issues around our ports, around our rail services, etc. Those things I think are reasonable when one to consider when one looks at the Rand at the moment. One of the fears I have right now, and we'll discuss about later as well around inflation, is that the South African Reserve Bank might be a bit more eager to cut interest rates a bit quicker, or might not be wanting to raise interest rates much more than what we have right now. Maybe another rate hike and might be done around that, which might be a mistake. If the Rand is weak, if we already are going to be seeing, like we talked in the second, changes in inflation forecasts globally, it could be a serious mistake to be preemptive around interest rates. I would rather us follow than basically be leading. The reason being is that as the currency gets weaker, our imports get more expensive. As imports get more expensive, inflation rises, causing us to have to raise interest rates in the future anyway. Okay. The next thing I want to talk about is what's happening with regards to the internal combustion engine legislation coming out of the EU and parts of the US as well. There has been serious moves to ban the sales of cars with internal combustion engines, basically cars using diesel or using petrol to run. The idea would be switching to EVs, switching to other kinds of vehicles that don't use the internal combustion engine. Why is this important? Well, in South Africa, we have a lot of platinum producers. Platinum is primarily used for vehicles, with petrol vehicles, diesel vehicles, etc., to help clean the exhaust. Not just platinum, palladium, rhodium, all these platinum group metals, derive much of the revenue from the internal combustion engine, industry. If we are to see these basically engines phased out in much of the developed world within a decade and say a couple of years, maybe 12 years, 13 years from now, that is going to be a serious impact, because remember, mining operations are not for 1 year, 2 years, or 5 years. They're multi-decade operations, and their valuation comes from multi-decade expectations around revenue flow. If revenue is going to be cut significantly within, say, as much as a decade, the valuation of some of these operations falls dramatically. Now, look, we have to take this with a pinch of salt. Just look at what happened with regards to some of this anti-coal legislation that the EU had in place until we had the Russia invasion of the Ukraine affecting the supply of natural gas. A lot of that legislation got thrown out as necessity required. And I think that might be the case around the EV market as well. I think some of these goals that are being set of replacing all new sales with electric vehicles by 2035. I think that's a bit too optimistic. For one, the amount of resources required to do that. The amount of copper, the amount of lithium, or whatever kind of other metals are used to break the batteries are not just basically high. They make a significant difference. Now, copper is not that much, but we're talking about I think about a third more copper needs to be produced than is produced right now. In terms of like lithium, using current technologies, if you had to replace, all the electric vehicles and all the current vehicles, electric vehicles in like Europe and North America, etc., and you include places like China probably in that as well, you'd be looking at an order of magnitude increase in the amount of lithium the world demands every year. That's like 10 times plus more lithium that the world would need every year. That is going to be very difficult to achieve in a period of a decade or so. Like I said, mining operations are multi-decade things. You have to have transport links. You have to build port infrastructure, blah, blah, blah. You have to build the facilities, the battery companies, etc., the battery operations to basically make the stuff work. It's going to be very difficult to achieve these goals in the time frame allotted by the legislation. But that being said, if people do start to see may not be done in 2035, but it's definitely a case that we are having the internal combustion engine being phased out. It's going to affect platinum prices. These mines, their lifespan becomes truncated dramatically, and the valuations will be decreasing as well because of that. And finally, we look at inflation and what's happening in there, and what information we got this week around US inflation in particular, but some other numbers out there in the rest of the world as well, including South Africa. So US inflation came in lower than last time, but higher than expected. About 6.4, we expected 6.2. It's a drop, but it's not as good as we were hoping for. There were some retail sales numbers coming out that were much better than expected. We also have recently had some jobs numbers coming out that were much better than expected. What does this mean? Okay, even though inflation is coming down, it's not coming down at the rate that we needed to come down at in order to justify the Fed basically cutting very soon. The next thing is that we are seeing some very troubling signs around, what's happening, especially in the job market. Why? People are not basically losing their jobs. They are not, finding massive amounts of unemployment. And of course, that's a good thing. We don't want to have people unemployed, except for the fact that unemployed people are one of the things that the central bank uses to cut inflation or to stop inflation from growing. We saw retail sales coming in better than expected. People are getting a bit optimistic. They're buying a lot of stuff. We are seeing things, for instance, like CPI for services, rising, even though the CPI for goods is falling. Now, why is this an important factor? We're talking about sentiment around retail. We're talking about job numbers. We're talking about services CPI. I've said in the past, and I'll restate it here. To understand how inflation becomes permanent in an economy, you have to understand how it works to the wages in the economy. The price of oil can go from 100 to 200 and back to 100, and it will make it'll be a temporary kind of thing. 100 to 200, come back to 100. It fluctuates. We've seen that in the past. We've seen huge jump up and huge falls in oil prices. Oil has even been negative in some times, in some places in the last little while. We had that famous case where oil was negative for a couple of days in the US because of the inability to store the amount of oil out there. You do not find wages being anywhere near as volatile as that. Once wages start to increase, those increases become permanent. They are very, very rarely pulled back. Once we have a trend of wages increasing by a certain amount every year, it's again very difficult to change that trend. Why? Because people don't want to change trends. They don't want to basically take the risk that they don't get the wage increase that they asked for. They may not be able to basically adjust or not to the inflation that they're seeing in the market, in the economy. The US has been seeing a lot of inflation, much higher than expected, for a while. Even now, when inflation is falling, it's still like mid 6%, much higher than the average that they want over time. If you're someone out there getting, 3, 4, 5% wage increases, it sounds great, but you're not keeping, step with inflation. So you are effectively having less money, real money, for time. The only reason you would accept that is because you are fearful about your job. If you would not accept effectively a pay cut continuously for a couple of years, unless you're quite fearful about your job. But if you're not fearful about your job, if unemployment stays really, really low, if the economy does not go into a recession, if you are thinking about interest rates falling in the near term, what are you going to do? You're going to say, I'm pretty secure. These guys can't really hire anybody else to replace me because there's not many people left in the market to be hired. And I'm basically falling behind in wages. I want higher wages. And that wage, like I said, becomes something that never gets pulled back. And if he does that for a couple of years, say 3, 4 years, that you demand these higher wages and you get them, in year 4, if the CPI basically gets cut in half, you're not going to adjust your wage demands as quickly as that. Wages are sticky, wage increases are sticky. And wages are the way in which, supply shocks turn into actual longer term persistent inflation. And in terms of what we are looking at right now in the US, we are seeing inflation fall, but not as fast as expected. We are seeing the wage, or the labor market, the labor economy, looking very, very strong, very low levels of unemployment. At some point in time, workers are going to stop being afraid because they're not losing their jobs. They're seeing the economy doing reasonably well, and they will have to turn around and ask for those wage increases that they've put off all this time to get them back at least on track to where they were in the past. And that is why I'm really kind of concerned about these numbers coming through. Deutsche Bank has come out after especially the inflation number and changed their forecast from 1 hike more this year to 2 hikes this year. If you see a number of other banks do this year, we are going to likely see a pushback as to when we're going to see interest rates fall, and a pushback to when we would likely see fundamentals in the economy change. We've already seen the market rise quite strongly over the last few months because anticipating an interest rate fall, anticipating a pivot by the markets, by the central banks. If we don't get that pivot, if there is evidence as to why the central bank should not act right now but rather postpone rate cuts, or even have more rate hikes than we had anticipated and hold them for longer, that is going to translate into a weaker economy and a weaker market especially. So pay attention to this and keep an eye on things. Okay, that's it for this week. Thanks for joining me, and I look forward to speaking to you guys again next week. Cheers.